Hey guys, welcome back. It's another week for Wealth Circuit Investing. So I'm glad you guys are here. I got to thinking about it as I was waiting for the clock to turn over to 8 o'clock p.m. here Central Time. What a cool environment we have. What a cool collaboration that we have as a group of investors who get together and just talk about investing. And it just was a blessing to me, so I thought I'd pass that on. I'm grateful and thankful for you guys who show up week in and week out for this kind of content. And it sounds like there's two football games on tonight, so we're but neither one of them are talking about the market and investing. So, but we are. With that, let's get going. Hey, let's see who all's in here tonight. We got some cool questions that came in, so I'm looking forward to hitting up on those. We got Mr. Swami, and hello, Mr. Beekeep, and hello to you, Mr. Swami. It's good to see you, my friend. Bob is back, and Bob, one of your questions is one of the ones we're gonna address tonight. So I'm glad you're here. And yeah, that Michael is pointing out that there is I guess it's a tropical storm at this point that looks like it's going to hit into the Gulf and eventually become Helene, I think is her name. And so hopefully she does not give us a lot of Helene. But anyway, it's I'm up in the northern part of Alabama, but it's still, even when they come up here, it is pretty rough from a wind and rain perspective. So can't imagine what they're dealing with down on the coast. Rust is here. Happy Monday to you also, my friend. Good to see you. And Bob Denkers. I don't think that I've ever met you, Bob. So welcome to the program. It's great to see you. El Dynamico is here. Good evening to you, my friend. Good evening to Fast Eddie. And Honeybee is here. Good to see you, Honeybee. Oscar has joined us. And my buddy Jim Betts is here. So it's good to see you, Jim. And so with that, let's go ahead and get cranking into some of these questions that we had. I want to share with you this screen here. All right, I'm going to get rid of Jim. Sorry, Jim. All right, here we go. So this is the Wealth Circuit Investing Hour, strategic dialogue for discerning investors. So tonight we got some really good questions. And so, yeah, I thought I would just give my thoughts on them. Whether I'm an expert or not is, up for debate. So, but at least I'm showing you my my opinions on it. But the cool thing is we have hit episode number 40. So glad you're on for episode number 40. But without further ado, let's go ahead and get started. First question was, and this comes from Bob the Thinker, not Bob the Builder, Bob the Thinker. So Bob says, "Hello, Kevin. I've been watching you on YouTube and enjoy your videos and live stream. I appreciate that. I really it means a lot to me when you guys get some value out of what we're doing here on YouTube." He says, "I have about 25% of my portfolio in T-bills. It's down from 40% a year ago. I sell puts, and as they get assigned, I use the T-bills to pay for the stocks. I'm thinking of getting invested close to 100% in the market, but how would you go about it? Just dump everything into VU or VTI or similar, or DCA into them, and what's your opinion? It's a substantial amount of money, about 1.1 million in T-bills. Let me know what you think. Thanks." I think he meant to say Bob, but it's Bo. Hey, Bo. So anyway, I've got some thoughts on that. But before I give them, I thought maybe for the group, I would give a little bit of background on what T-bills are. So T-bills are short-term U.S. government debt obligations backed by the Treasury Department with a maturity of 1 year or less. I think they go a certain number of weeks, maybe 3 weeks up to 52 weeks. You can get them in various time frames. And I found this to be kind of interesting. These are some of the 4 week, 6 month, and 1 year yields on T-bills back 10 years. So 2014, I guess it's pretty low, and then it starts rising right back in 2016 up to 19, and then it drops dramatically, almost back to zero when the pandemic hit. And then when the Fed started raising interest rates again, guess what? T-bills went up, and that's what we're seeing here. Early 22, they started going up from zero, and then by the end of 22, they had hit roughly 5%, 4.5 to 5%, and then through 2024 went up just slightly, not significantly, and up until today, or up until whenever this was, and I don't know what the date of this is. It was, it's been pretty consistent, and that's because the discount rate has been consistent. So, okay, so that's kind of that, and then so the T-bills are short-term U.S. government debt instruments, and they protect the downside while providing a market-based yield. So, right now, investors are getting, anywhere from, let's say, 3.5 to 4.5% on T-bills, which is a pretty good yield, and it protects the downside. So they got that going for them. Where will the market go from here? Will there be a soft landing? Will there be a recession? Will there be more inflation? The answer is who knows, right? And so I think it really depends on, first of all, the decision to move from T-bills into equity, I think depends a lot on how much risk you're willing to take, and how much, if you're not willing to put some money at risk, then it may not be a good idea to move all of your money into equities. I am very comfortable with that. So I am, completely, actually, I think that's the next bullet point. The Wealth Circuit portfolio does not have any T-bills or bonds. I am completely 100% in the equity market. I'm very comfortable with that risk. And I have a lot of things in place that help me manage that risk. Okay. So I don't want you to think that, one day I just woke up and said, hey, all my money is going to go into equities. There are a lot of things that I've put in place, not only rules, but also guidelines that I follow that help me manage the risk of the equity market. Doesn't mean I'm not going to lose money, but it does mean that I have some things in place. And so when I think about, and let's go back real quick to this chart. If you think about back in 2022, it's when the interest rates started going up, and then January 2023 is when they were kind of at their peak. So if you recall, in the market at that time, the S&P was down like 20, maybe I got that wrong, maybe 17, 18%. Total return wise, it was down about 17 or 18%. However, T-bills, you got your 5%, or on average, it was 2.5%, I guess, depending on when you bought in. So, but you didn't lose your principal either, right? But I will tell you that in 2022, my portfolio actually went up 1% total return wise. Now, it's not as good as if I had been in the Treasury bill market, because I mean, if you think about it, from 0 to 5%, somewhere in there you're going to have invested money at 0, and somewhere you're going to invest it at 5%. So on average, you're at a 2.5% for the year. So 2.5% for T-bills, 1% in my portfolio. I'm perfectly fine with that. I'm comfortable with that. But then you look from 23 to 24, the yield is pretty much the same, somewhere around 5% for T-bills. But my portfolio did over 12% last year. And so far this year, it's up over 16%. So I'm very comfortable with the downside risk. And so I just wanted to point out that there is risk to moving from T-bills or bonds into the equity market. So I just wanted to pass that on. The challenge with T-bills is that their yield will fall in a period of declining rates. So as the Fed has predicted and projected, they are going to reduce their rates over time. And so therefore you will see Treasury yields, T-bill yields come down, just like they went up when they were raising the interest rates. So you got that going for you. So there's, it's one of those things where you say, where am I going to get some return? And sometimes, you got to take a little more risk, especially when the Fed is reducing discount rates. So if it were me, and that's the only advice I can give you, is what if I were in your situation, what would I do? I would probably DCA into, and that's a dollar cost average for those of you who don't know what DCA is, into like an ETF that would be an S&P 500 ETF like VOO, or even a full market like VTI. But I would also go into something like DGRO, so you get some really good dividend growth companies, and even an SOXQ, so you can get some exposure to this Silicon Valley stuff that's going on. So all the chips and things like that. So I'd do that maybe over a 3 to 6 month period. But I will tell you this. Excuse me. Let me get a drink of my iced tea. Unsweet iced tea, by the way. What I would like to share is that when you DCA, and it's not necessarily when you are growing your portfolio, but if you have a large portfolio and you say, hey, I'm going to take a chunk of this and I'm going to DCA into something, it doesn't matter what it is, but it is a guaranteed regret. So just be ready for that. So as you're DCAing in, if you DCA in and everything moves downward, you're going to regret having done it so early, or you regret having done it at all, right? So there's going to be that regret. If you, start DCAing in and it goes way up, guess what? You're going to regret not having done it all at the beginning. So either way, you're going to have delay or guaranteed regret. Like that's something that I've experienced. And, anytime I DCA in, I automatically know I'm going to have some regret. So just get ready for it. All right. It sounds, Bob, like you play around with some individual stocks because you're doing these puts and things like that. So maybe some individual stocks as well, but only buy individual stocks when you're ready. So I would DCA into these ETFs if it were me, and then I would, buy some individual stocks as things looked attractive to me. So hopefully that's helpful. And, let me know in the comments if I missed something or if something has changed since you left that question out there. So, but there was one other question I thought I would hit on, and that is from Money Mind. It's when I've only got a small position, like one share, and it comes time to take profit. What are my options to realize? And I think that means to realize that profit. So I would say the only way to take profits is to sell. I mean, otherwise, you could probably play around, get cute with maybe some option strategies or something. But I would say the only option you have to realize a gain is to actually sell the security. So that would be the only option. But just be clear on your rules for taking profit. I have clear rules for the Wealth Circuit portfolio on when I'm going to sell and capture a profit. I won't go through them here because it's just not what this question is about. But be clear on the rules that you have. Many times, though, just to give you something to think about, many times we are better off selling our losers and keeping our winners. So, just know that I think it was Peter Lynch who said, sometimes it's better, many times, I guess all the time, in a garden, it's better to pull your weeds and water your flowers rather than pull your flowers and water your weeds. So, and the weeds in this position, or in his analogy, is that those stocks that are losers, right? So those are weeds in your portfolio. Sometimes we go, oh, wow, these are doing really well, so I'm going to go ahead and capture the gain on the ones that are doing well. And then the ones that are doing poorly continue to do poorly. So as a portfolio, sometimes we don't maximize our earnings because we're so worried about capturing the gains, and then we let our losers run, and it should be the other way around. So just keep that in mind. I'm not saying that any particular stock, because I don't even know what stock you're talking about here, but that's really not your question. It's about the small position. And I'm assuming that your portfolio, because it is such a small position, I'm assuming that your portfolio has a lot of a large number of holdings. So you might have, I don't know, 60, 70, 80, 90, 100 holdings in your portfolio to have one with such a small position. So I would consider reducing the number of holdings in my portfolio. I did that here about a year and a half ago. I looked at my portfolio, and lo and behold, I had 42 holdings in it. 42 was just too much for me to keep up with my process. I was doing my best. I was trying hard, but 42 was just too many. I ended up getting that down to about 23 or 24, and now I'm back up to 27. So I've got to maybe take a look at whittling that down by a couple. I want to try to target around 25 stocks. But, to be honest with you, there's not a lot in my portfolio that I'm sitting there going, I need to get rid of this stock. Everything that I have is more than 1% of the portfolio. So it has a meaningful position in the portfolio. Most everything I have is either around 2 to 3 or even 5% of the portfolio. So, it is what it is. So I will continue to look for ways to reduce the number of holdings that I have. But there's nothing jumping off the page at me at this point. So, but I would say if you have a really large number, consider reducing the number of holdings. Diversification, let me just say this. Maybe I should have made some slides on this, but diversification reduces your downside risk. And that's what everybody wants, right? So they say, hey, you know what? If I have one stock and it goes down 10%, I'm down 10%. If I have two stocks, one stays the same, one goes down 10%, and they're the same value, my portfolio only went down 5%. And then if you do four stocks, it only went down 2.5%, right? And so it kind of, it's like a shock absorber. It keeps the portfolio from being impacted on the downside as much as if you had only just a few holdings. So the more holdings you have, the more insulated you are from downturns in your stocks, in your individual stocks. But that also works on the upside. So if you've got, one stock, as let's say you got 100 stocks in your portfolio, and one stock just blows it to the moon, it's probably not going to show up very much in your portfolio. And then, the same way, if one really craps the bed, then it's not going to show up a lot in your portfolio. So I would just say that, it is important that we're diversified, but don't over diversify to a point that your holdings don't really mean anything anymore, if that makes sense. So another thing you might consider is a core satellite strategy. What that is you basically have a core strategy of ETFs. And you could do, like we talked about earlier, you could do VU, DGRO. There's a lot of good ETFs out there. And so that gives you a lot of diversification. But then you might even pick some individual stocks if you're interested in individual stocks, and just have them be a little bit bigger piece of your portfolio, but just fewer of them, if that makes sense. So, and you can, Google core satellite strategy. It's pretty well-known strategy out there. Let's see. So that's that. So I thought I would then share based off of that. There's two investing lessons that I have learned. As you guys recall, I went through my the transactions I've done since April of 2021. April of 2021 is when I retired, and I started my dividend growth portfolio at that point, and eased into it. Actually, I started easing into it in April, really got much bigger into it in August, and then much bigger in October, and then eventually put my whole portfolio into it. So what I've done is I went back and I took all of the transactions from that time, and I put them in a database, and I've really analyzed and I track the total return on every investment that I've made. And as you know, it's kind of easy to hide if you just show your current investments, because let's say I invested in a stock and it did really poorly and I sold it off, or if I invested, over time, and I bought some really high and some really low, and then it ended up in the middle, and I sell off my high ones, then I end up with the low ones, and it looks like I'm just a great investor. So, looking at somebody's current portfolio doesn't really tell you how good of an investor they are. Looking at the entire portfolio, the entire thing, that tells you, how good an investor somebody is. So that's what I'm measuring myself against. And so once I make an investment, it never goes away. I may sell it off, but in terms of me looking at it from a performance perspective, it never goes away. And it's always there to remind me of things that I didn't do very well. So hopefully that's good. But anyway, I went back and looked at all those transactions, and I came up with 20 something lessons that I learned. And one of those, maybe this applies to my friend Money Mind, is that you don't have to swing at every pitch, right? So, if Mr. Market's going to be slinging a lot of balls at you, right? And some are going to, be over the plate. And you might think you have to swing at everyone that's over the plate, but you don't. You don't have to swing at all of them, but you do have to swing eventually. And so, just pick the ones you really want to swing at and swing at those. Don't swing at everything. Don't have this fear of missing out that causes you to swing at everything. All right. Oh, then the second one I would share, and this is again, this is my lessons learned. You may not agree with this, but that's okay. These are mine. Those holding more than 40 stocks should consider an ETF strategy. So if your portfolio is larger than 40 stocks, you might consider using ETFs as opposed to individual stocks, because 40 stocks is, first of all, it's a lot to keep up with, as I found out with 42 of them. And then secondly, it's it's almost like you have an ETF anyway. So if you have 40 stocks, it's just a lot. So what I do is I have some ETF, and then I have the rest of it in individual stocks. So that's just the way I do it. All right, so there we go. I think that's it. That's all for the questions. So hopefully that's helpful. And let's go back to, let me get, it took me off the screen. Let's take that off the screen. All right. Things are going well tonight, guys, already. Let's see here. Let me go back to where I was. I was at gym. Let's see. Yeah, that's right, Michael. It's four. I think those are all. I don't invest in TBills, so I don't keep that on top of mind. But I do recall there being at least four, and 4, 13, 26, and 52 weeks were the ones that I remembered. Dinkers means thinker in Dutch. That's great. That's great to know. So maybe you're the Bob Bob the Thinker. So that's awesome. But whichever Bob it is, hopefully that was helpful for you guys. All right, hang on. I'm getting my magic ball out to see what's going to happen in the next year. Fast Eddie, when you figure it out, buddy, you let me know first, and then after a week, maybe we'll tell everybody else. How's that sound? No, I'm just joking. Michael has no T-bills, nor do I. I just bought REITs instead of TLT. I think, I'm not really sure, because the REITs have really run up, and there's these rate decreases. I don't know how much of those are already priced into our REIT friends. But I think, with rate decreases also comes capital gains on real estate. So there may be some room for that to run still. So, yeah. So Jim is asking, isn't your SPACs position heavy into T-bills? Yes, it is. But it's real. I consider it more of a money market account. So what SPACs is it's the place where my cash is held. So if I don't have all of my funds invested, like currently, here, I'll just go ahead and pull this up and add it back. So if you look here, maybe I should make this a little bigger. This is my this is that spreadsheet I created, and I use it to track my portfolio because I couldn't find a good portfolio tracker, and so I decided to create one. So here it is. It's in Excel, and uh, what did I come here for? Oh, this cash right here. So you can see my portfolio value, and then the cash available to invest is 66,000. That's not sitting in my back pocket, right? It's sitting in the money market account, and yeah, it goes out and it invests this cash into T-bills and things like that. But I'm not physically doing that. It's the money market that is actually doing it. So that's kind of the way I look at it, Jim. But you are right. I do have exposure to T-bills. I just don't buy them individually. So hopefully that makes sense. Kevin Mendoza is here. We now have a quorum of Kevins. There are two, and hopefully there are more later. Yeah, Southern Health Dynamica says Southern Sweet Tea is the best. You're not kidding, man. I do love sweet tea. Um, it's something I shouldn't love, but I do. And so what I do when I go out to a restaurant is I'll do half and half. I'll get half unsweet and half sweet, just because it's better for me. I trick myself into saying it's better for me, but this is unsweet tea. Michael says he could tell I'm from northern Alabama based on drinking unsweet iced tea. Yeah, that is true. That's true. Actually, I am from Arkansas, and my career took me from Arkansas to Memphis to Mississippi to Indiana to Ohio, and that's where I spent probably 21 years of my career, and then I retired and moved to North Carolina, and now we live in Alabama. So we just kind of made the circle all the way around that part of the U.S. So yeah, I get my unsweet tea probably from Ohio. All right. Rust wants to know about CSL. I really do love CSL. But you know what? Let's go take a look at my little stock tracker thing here. And I got to find my cursor. There we are. I'm going to add this back on the stage. I'm going to go to my stock listing here. And let me sort this again. I was playing with it earlier. All right, let's look for CSL. See where it is. Carlisle. All right, so it's looking to me like about 12% would be the expected return over the year. And what do we have here? Time analyst ARP. So yeah, the analysts are actually saying it's going to be 8%. So mine's a little bit more aggressive than the analysts are. So I think there's going to be some decent returns there. I just don't know if it's enough for me to jump in. It looks like it's overvalued, maybe even by 20%, according to Morningstar. Let's take a look at this. Morningstar says their fair value is $359. Their current price is $442. So it's a bit on the pricey side still for me at this point. If it were to drop in value, then it would be a much more attractive investment for me. But right now, 12% is not bad. And even 8% is my target. So I target investments that would get me an average portfolio return of at least 8%. But it's just a little bit on the pricey side for me. There are others, I believe, that are, oops, picked the wrong one. Not sure what I did there. Have to back this up. There we go. There are others that I believe have a better return potential uh, for the stocks anyway. So I do like Carlisle a lot, and if it comes down, I'm a buyer. But at this point, it is a hold for me, and it is still on my watch list. So hopefully that is helpful. Too close to those Tennessee heretics. Yeah, that is true. I'm actually not far from Tennessee. I don't know, probably 40 minutes, maybe something like that. Sweet tea is terrible, according to Fast Eddie, coming from another unsweet tea drinker. There you go, my friend. I like them both, but just so happens this is unsweet. So, it's like the guy said. I used to work in Mississippi. There was a buddy of mine. His name was Laguna Bean. Laguna Bean, and we went on a business trip one time, and we were checking in the hotel, and the desk clerk pronounced his name Laguna Bean, and he said, "Yeah, that's it." She goes, "Man, I love that name." She said, "Where'd you get it?" He said, "Oh, my mama gave me that a long time ago." I just rolled. It was the funniest thing I'd ever heard. So, anyway, Laguna um, ran for the school board. He ran unopposed, and his platform was, "Some of my friends are for it, some of my friends are against it, and I'm for my friends." So I'm the same way with tea. Some of my friends like unsweet, some of my friends like sweet, and I'm for my friends. So there you go. You guys didn't think I'd bring that around, did you? I almost forgot where I was going with that for a while. All right. Okay, we found a new stock for my watch list, KMI. That would be KMI. I used to actually own them. Let me see if they're in here somewhere. Um, why can't I think of their name? Kinder Morgan. That's who it is. So, yeah, I actually have them in here. Let me see if I can just find them in the midst of all of the noise. It's KMB. Yeah, when I've got 70 stocks in this watch list now, and sometimes it gets a little unwieldy. So I think what I'll do is go ahead and I'm going to put it back on the stage here. But I'm going to select it. Oh, I know what I was doing earlier. I was wondering why I couldn't get it back, but now I know what I was doing. All right, Kinder Morgan, here it is. I'm showing it with a 7% return potential, mainly around yield. It's growing by about 5%. I mean, it's not growing. It's paying its dividend out at about 5% yield, growing at about 2% per year. But it's trading at around fair value. So that's what you want. Then it's that's what you can get. I just tend to think that there's a lot better total return providers than KMI. So therefore, I don't own it anymore. It is no longer in my portfolio. Oh, but you want to see what I have made on it? This is the historical investment. It is the entire 102 companies that I've invested in, and you can see here the total return over this time period. So what is that? About 3.5 years. Started in April 7th of 2021. It's about $440,000 positive. You can see that some are negative, right? I had 7 investments that were $500 loss or more in the portfolio. But let's look for KMI. Let me find it. Kinder Morgan, there it is. I ended up with a $1,532 total return, and it was all from dividends. It was all from dividends. Look at this. My realized loss was $59.81, but the dividends were $1,591.91. So I ended up with a $1,532 total return from Kinder Morgan. So there you go. All right, there we go. Oh, you're welcome, my friend. I'm glad for the question. That was really a really good question. It was one that I needed to spend some time with. So I appreciate you letting me have a little bit of time with it. So 13B, you miss 100% of the shots you don't take. Wayne Gretzky. That that's true. I don't know what 13B is, but that is true. You miss 100% of the shots you don't take, but you also if you don't swing, you don't strike out. So yeah. Oh, you miss. There you go. You miss of the putts. Okay, we got a lot of stuff going on here. Yeah. So Bob Wright says, yeah, he's not the thinker. Hopefully you got your thinking cap on when your stocks with your stocks, though, my friend. That's awesome. All right. So, what do you guys want to talk about? The stage is yours. I thought what we'd do also is talk about the latest news from Simply Safe Dividends. But before that, we'll hit a few more comments. Thoughts on Intel based on new strategy? That's a good question. I didn't know they had a new strategy. So, I don't keep up with them. So, let's do this. Let me see if I can find something that would tell me quickly what the new strategy is. Let's see here. I'm going to just look at Seeking Alpha real quick. Seeking Alpha is good for like news articles and things like that. I don't see anything that acquisition by Qualcomm unlikely. I don't see anything about a new strategic move. So maybe if you can let me know, Michael, what that is. I've just not. I don't. I've never owned Intel, and at this point don't plan to own Intel because I don't like their strategy. Maybe if they're changing that, it might give me a reason to kind of think about it. I just think they need to pick a lane, right? They need to either be a fabricator or they need to be a designer, and they want to be both. And to be a fabricator costs a lot of money. It takes a lot of capital, and they're going to have to bring it to be a competitor to TSMC. So, I don't know. Maybe they've decided to go one way or the other. Oh, Pat, you have arrived, man. I'm sorry we had to go ahead and get started without you. Normally we would wait, but tonight we needed to go ahead and get started. All right. Is Qualcomm buying Intel? This is from Honeybee. It's said in this, here, let me go ahead and, I've got to switch gears here. Give me just a second. I'm going to share the whole screen. All right. So it said it's not likely. So this was it's today at 9:23 a.m. It says Intel acquisition by Qualcomm unlikely. So I didn't read the article, but the the headline kind of gets your attention, doesn't it? So I don't think Qualcomm is buying Intel. But that article said, and even the article says it's unlikely. But it's funny, they can do that with articles, right? They can say, Kellanova's acquisition by Johnson and Johnson is unlikely. Well, yeah, it's unlikely because they're not going to buy them. So I don't know. But then everybody goes, "Oh, wait, is Johnson and Johnson buying Kellanova?" No, it was never even an option. But it was a nice headline to get you to click on the article. So that could be what it was, Honeybee. I don't know, but that's where I got it from. So thought I'd share that. I'll go ahead and remove that. Nobody wants to see all that stuff. El Dynamico, when did Realty Income increase their dividend? That's a good question. Let's go check. I don't own anymore. I don't own Realty Income. That's the monthly income, monthly dividend company, I think they call it. Based on what I see, they increased it for the October payout. So it went from point. Yeah, hold on to your seats here. It went from 0.263 cents per share to 0.2635 cents per share. So they basically raised it about 1/2 of 1%, something like that. It's very small, but at least they raised it. It went up. So that'd be basically it's 4 decimal places out. So it would be it basically it's not much. So anyway, math is kind of evading me tonight, but it's not much. Did you see the nuclear utility stocks rise like CEG on the partnership with Microsoft? No, I didn't see that. Is that recently? What is it? All of them? Did the NRC decide that they're going to partner with Microsoft and therefore all nuclear plants will benefit from it? You said CEG. I think that's Constellation. Let me see. CEG. Yeah, Constellation. Yeah, I don't know. I did not see that, so I'm glad you brought it up. It's something I'm going to look into, though. Oh, good. Michael says Intel's looking at abandoning their fabrication strategy. I think that is a phenomenal move for them. It is, in my opinion, what has gotten them in the most trouble from a strategic perspective. So I would applaud that. I still don't know that I would buy Intel until I saw that they could actually win with that strategy. So, I don't know. It's a great strategy. I mean, I like the strategy better, but it's still not. I still want to see them do something, as opposed to just telling me what they're going to do. Yeah, increases their dividend frequently throughout the year. Yeah. That's right. That's a good point. Oh, I've already moved on to Constellation. Let me move back. Yeah, no, that's a great point, Michael. I even though I said it was the monthly dividend paying company, I didn't even recognize that. So, yeah, so they've raised it. Let's see, starting in January, they raised it in January. They raised it in April. They raised it in June, and they've raised it in October. So they've raised it 4 times. I'm sorry, June and then July and then October. So they raised it 5 times this year so far. Out of they've already, I guess, given notice of the October dividend. So out of 10 months, they've raised it 5 times. So roughly every other month, they're raising their dividends. So yeah, that's a good point. Yeah. El Dynamico says, "Oh yeah, raking in that 1/2 cent." I'm not even sure it's that much, but it's half of something. So let's go to. Let me see if I've still got that up. Yeah, let me go to. I'm going to add that to the stage, and we will go over to seeking out Simply Safe Dividends. And what I thought would be fun, because I know Russ does this from time to time, but I don't know if he did this last night or not. Oh, actually, he did it on his show was on Friday night, so there's been a lot that's happened since then. So let's just start here. It was a week ago. Microsoft hiked their dividend by 11%, reaching the 15th consecutive year of payout growth. So 11% is really nice. I'm really appreciative of that. Normally it says, "Oh, this is just the general news." If I were to go into my portfolio, it would tell me how much that is on an annual basis for my portfolio. It's 8 cents per share, and I own about 190 shares, so it's not much. I think I can buy maybe a Starbucks coffee with that. But it's going up, and that's what matters. They refreshed their outlook on Iron Mountain, but didn't say much about it. It says it could be overvalued. SiriusXM simplifies corporate structure, reiterates dividend commitment as focus turns to deleveraging. So that sounds like a good sign, right? For Sirius to be focused on deleveraging. Simplifying is a good thing. Saves money in the long run. So I think that sounds reasonable. I don't own Sirius. Oneoak's $5.9 billion acquisition strengthened the portfolio. Dividend profile remains strong. So they evidently like the Tulsa-based pipeline operators acquisitions. So that's good. They're still at a 60 borderline. Who is this? Oh, Love. This is Southwest Airlines. Operational missteps, which is unusual for them. I mean, they are, when I was getting my MBA, Southwest Airlines was one of the case studies of operational, excellence. So this is not a good sign that my friends from Southwest Airlines have operational missteps and industry pressures stretch Southwest dividend coverage. They've decreased them from a borderline 60 to a borderline 50. So I don't own Love either. Texas Instruments, I used to own them. They lifted their dividend by 4.6%. This is they should do some spell checking on this. This is the consecutive year of 21st year of payout growth, so that's a good sign. UGI, I probably should look at UGI again. I did own them for a very brief time until I saw all that was going on behind the scenes. To me, it was kind of like the Wizard of Oz. It was like all this show, and all of a sudden there was this little guy in the corner that was making all the things move, and so I decided to get rid of UGI. They became the first, I knew all that, but they've got a dividend safety rating of 60. I need to take a look at them, though, and see what has changed, if anything. I know that they were selling off some of their assets, but and then ultimately end up as a regulated utility. And I just felt that their price was too high at the time to be a regulated utility. And let's see, Xerox. I didn't know Xerox was still around, to be honest with you. So their reinvention plan faces uncertainty as printer sales fade. Dividend outlook is less stable. They're going from an unsafe 40 to a very unsafe 20. But hey, you know what? You can get this huge dividend yield, 9.83%. See the problem with chasing dividend yield? It's it probably won't stay there. It'll probably be gone. They haven't grown their dividend yet this year. So anyway, there we go. GGG. Cool. All right. Anything else you guys want to hear about? Let me come back over to you guys. Find my. Yeah. Let me get rid of Simply Safe here. So El Dynamico says they've raised it 5 times and it's still at 26 cents. Now, ain't that something? Yeah. But, it's what's the yield? I didn't even look. The yield is pretty good. It's 5.07%. So, if you're looking for a REIT, one of my issues with Realty Income is that it's gotten so big that it takes huge real estate deals for it to continue to grow. And so it's just a little bit too much of a stretch. It's $54 billion company now. $54 billion. That's pretty big. Not that there's anything wrong with it. I don't think it's going to go, under or anything like that. I'm just saying that it's going to take a lot for it to continue to grow at that pace because it's just so big. Anyway, Jim says CEG is going to fire up the nuke plant at 3 Mile Island. Oh, I did see that. So they must own TMI1 because the company that I used to work for owned TMI2. So 3 Mile Island, they must be going to fire up the first reactor there. I did see something about that. I sure did. But, I think that's going to be a little bit into the future. So, but, we'll see. Who knows? It is good, though, that site has been cleaned up enough that it can be used for other things. So I will say that. Oh, and one in Iowa as well. That's good. I don't know which one that would be, but Rust says that McDonald's hit an all-time high today. Let me go check this out. Stock market analysis. Wow, they sure did. I'll show it to you. Look at this. Very nice. This is a 5-year chart here. Obviously, the 10-year doesn't get any worse. So, yeah, they're looking pretty nice. Does that mean you're going to buy some, Rust, or you think it's a hold? Swami, he doesn't own O, but they usually have one larger increase each year. Yeah, that could be. So Kevin's got a question for Kevin is, do I like TPL? And I'm not sure that I know what TPL is. Texas Pacific Land. I don't know that I've ever heard that. Texas Pacific Land. So let's take a look at it. First thing I'll do is go into here, just because I get a lot of information all at the same time. So, except when they don't cover it. It's an oil and gas exploration and production. It has a dividend yield of 0.49%. It's trading for $950 per share. And they've got some, this was the pandemic, so we'll give them some slack on that. Their dividend has been growing, but the yield is very small. It'd be something I would need to look at their strategy, though. This is more of a growth company, I think, than a dividend company. Let's see what Morningstar says about their fair value, if they even cover it. They don't cover it either. So it must be pretty small. Well, it's $22 billion. That's not small. It's a large cap company. But some of these apps just don't cover them. Let's see what FastGraph says about it. It says it's pretty high compared to where it's always traded, and even compared to the 15 times earnings. So it's up around 48 times earnings. That's pretty significant. So anyway, do I like them? I don't really know. I've never seen them before, but 48 times earnings or whatever that was, almost 49 times earnings. That's pretty pricey, man. Unless there's something that we just don't know about. So Michael, he's got some. Michael Swami has some core holdings. It's Xerox, Kodak, and Stagecoaches. That's good. I taught some seminars on strategy, and one of the things I would use as an example are the lap blankets that they used to sell for stagecoaches and even just wagons in general. So it's you can have a good strategy and you can have a good plan. You can be operationally efficient, but if your product just goes out of favor, there's not a lot you can do about it. So, and that's unfortunately for Xerox, Kodak, and Stagecoaches, and lap blankets. They all kind of fit in that pattern. We did a case study on Southwest in my Principles of Management class. Nuts. Southwest Airlines crazy recipe for business and Personal Success, a great read. Yeah, I agree, Jim, and that's why I'm really surprised to see that article that they had operational missteps. I mean, they are the poster child for operational excellence. Okay, let's see what Russ has got going on here. He says, I'm holding my shares, hard to buy at all-time highs. That's this McDonald's. But I will go buy a McChicken. Yeah, I mean, why not? Go ahead and celebrate. You can celebrate with a McChicken sandwich. And, if they happen to have the McRib, you can get that too and have a McChicken rib sandwich. That'd be fun. Yeah, Michael says TPL is a yield trap. Yeah, I mean, it's hard to say though because they don't have much yield. It's only 0.49%. I'm not sure what it is, but usually a yield trap would have like 8, 9, 10, 11, 12% yield. And so that kind of sucks people in and it traps them. But I don't know. I don't know about TPL. It just doesn't, there's just not enough there. Nobody covers it. Pat says O is up 8.53% year to date and up 21.74 for the last year. Yeah, that's right. And I think you would find that with a lot of the REITs. I think you'll find a lot of REITs have gone up, just like the utilities. With the anticipation these interest rates are coming down, all of these highly capitalized industries, which would include REITs, utilities, and I can't think of any others off the top of my head, but those are going to, win when the Fed is reducing the discount rate. Oh, yeah, that's right, Kevin. We need some slow. All right, so let me go back to some of these. And nah, I won't do that. I won't. But on the next ones, I got you, man. I'll take care of that. All right, what do you think of UPS? It doesn't seem to be going anywhere, and if the market drops, I think it will go down big. This is Billy Johnson. Hey, Billy, what's happening, man? How are things over in the Philippines? Good to see you, buddy. So what do I think about UPS? I bought some UPS, and let's see. I'm going to take a look at where I'm at with it. I bought it at 129.61, and it's trading at 128.74. So I'm down like $152 on it. So why did I buy it? I think the dividend yield's attractive. I think they are going to struggle in the short term. I think strategically they are going to be struggling with, not only with their labor. I think that the labor piece of this is difficult for them. The labor contract that they did and is just making them, helping make them uncompetitive. But the other thing that I think is, things like Amazon, who's doing their own kind of shipping thing, is United States Postal Service is delivering a lot of Amazon's packages now. That's where I get probably 90% of our Amazon packages. And our mailbox is kind of small, so if we get a package, the mail guy, and we live kind of way off the road, so he doesn't come to our house. He only comes to the mailbox. And if it doesn't fit in the mailbox, he takes it to the post office. So I end up driving to the post office to get my packages. And I know you guys aren't sad about that, but I'm sad about it. So what will it do? I'm going to give, going back to my buddy Kevin Mendoza, I think I'm going to give UPS kind of a mediocre. Uh, I'm not buying more UPS at the moment. I do think they're going to struggle, and I do think that they may see some lower prices. Now, am I going to sell my UPS? Probably not, because I've been wrong before. It could shoot up. Who knows? But I'm going to keep what I have. It's about 1.4% of the portfolio. But I'm not going crazy with UPS. I got it at that 5% dividend yield. and that's one of my 27 holdings. Let's see. Kodak. This is Michael. Kodak invented the digital camera and abandoned because it wouldn't. It would have hurt their film business. I didn't realize that. So that's not good. That's not good. Oh, okay. So Russ says the TPL does crazy special dividends. I would have to look into it. There's just not enough out there. I mean, not enough people cover that. And that's weird because Simply Safe had it at a 0.49% dividend yield. Oh, I see what you're saying. So back in here, I'll show you guys this. So that way I'm not at my own party here. So you can see here that there was a special dividend of $10 paid on July 15th. So that was pretty significant. But the standard dividend is still the same. We pay about $4, maybe closer to $5 a share. Here, let's say somewhere 468. That's the annual payout. So yeah, that is a crazy one-time dividend. But yeah, it's like $1,000 stock. So I don't know. That's even at $15. That's yeah, I guess that'd be a 15% dividend. Wow, at 468, that's still, I don't know. See, I'm gonna have to check this because I'm not sure. I mean, it does say. I mean, you guys can see that it does say 0.49% dividend yield, but I don't know. I just have to check that. I'll look into that a little bit further. Oh, Michael says he withdrew it. He was thinking of another company. All right, sounds good. All right, Dave Sakara, what did he say? Let me get rid of this. Boom. Again, recommended U.S. Bank on the Morningstar video this morning. Your thoughts on it? I know you own it. Yeah, I must have been daydreaming. I did listen to their thing this morning, but it's while I was driving and I was pulling a trailer, so I might have been distracted when they talked about it. But yeah, I'm a fan of U.S. Bank. I think it has grown a bit. I mean, my average cost on it is $35.27. It's now at $45.86. So, when it was 35, I was all in. Let me see what I think about it here. I mean, I have it on my list. U.S. Bancorp. I'm showing them at about a 10% annual return percentage, which is not anything I'm investing in. I have it as a hold, so I'm not aggressively pursuing that. Even the analysts believe it's 12%. So, hey, 10%, 12%, that's not bad, right? It's not a bad return. But I think there's some better ones out there. All right, here we go. Jim's always got some good things to share with us here. Little known fact, the McRib was developed at the University of Nebraska. Apparently, they didn't want the pig lips and whatever to go to waste. There you go. I tell you what, that barbecue sauce is really nice. All right, Slammer, right as I'm about to close the program out, Slammer 6789 shows up. We're at a minute or an hour and 4 minutes now, so I appreciate you guys joining. And like I said at the beginning, I really appreciate you guys being here. It is it's incredible to think that there's people that just want to sit around and talk about stocks, and I'm glad you're one of those. So I'm going to end this, and I will catch you on the next one. You guys have a great week, and hope everything turns out well for your investments. We'll talk to you soon.